right now, today, in February of 2026, you are sitting at what historians will look back on as one of the single greatest wealth transfer opportunities in the last 100 years. And most people are going to miss it entirely because they are watching the stock market, they are watching crypto, they are watching real estate, and they are completely, totally blind to what is happening right in front of them in the silver mining sector. And I want you to understand something very clearly before we go any further. This is not hype. This is not speculation dressed up in fancy language. This is hard data, real numbers, documented deficits, structural supply collapses, and a monetary reset that is already underway, whether you believe it or not. And the only question is whether you are going to be positioned before the crowd figures it out, or whether you are going to be reading about it on the front page of the financial news after the move has already happened. Let's start with the foundation, because without the foundation, nothing else matters. And the foundation here is a word that most retail investors never take seriously until it's too late. And that word is deficit. The silver market has now recorded 6 consecutive years of structural supply deficits, 6 years in a row where the world consumed more silver than it produced. In 2023 alone, that deficit was 184 million ounces. In 2024, it came in at 148.9 million ounces. In 2025, the Silver Institute projected a deficit of approximately 149 million ounces. And heading into 2026, analysts are projecting a further shortfall of around 95 million ounces, even as prices have already surged dramatically. Now add all of that up from 2021 through 2025, and according to Sprott, the cumulative silver supply shortfall has approached 800 million ounces. Nearly 800 million ounces of silver that simply does not exist, that was consumed, that was burned up in solar panels and semiconductors and electric vehicles and never came back because, unlike gold, which gets melted down and recycled and sits in vaults and passes hands over centuries, silver gets used up industrially and much of it is gone forever. That is not a trading story. That is a structural reality that no amount of central bank jawboning can fix. Now let's talk about where silver actually was 12 months ago and where it is today, because the numbers tell a story that is almost breathtaking. Silver entered 2025 below $30 an ounce. It ended 2025 having surged over 140%, more than doubling, making it one of the single best performing assets on the entire planet that year. Gold itself rose an impressive 64% in 2025, which by any measure is extraordinary, but silver blew past gold, which is exactly what silver does in the late stages of a precious metals bull run. That is the historic pattern. Silver lags gold early, then it explodes, and then the miners, the companies that actually dig this metal out of the ground, those stocks explode even harder. We saw a preview of that in 2025. The SILA-J ETF, which tracks junior silver mining companies, surged approximately 95% in 2025, outperforming physical silver itself. And here is the critical point. Despite that enormous 195% gain, valuations of silver mining companies relative to current silver prices are actually lower today than they were before the rally began. You heard that correctly. The miners are still historically cheap. They have not yet caught up to the earnings power implied by the new silver price regime. Let's understand why that is and why it matters enormously for what comes next. When silver was trading at $28 or $30 an ounce, mining a single ounce of silver cost most producers somewhere in the range of $14 to $18 in all-in sustaining costs. The margins were thin, the cash flows were modest. Investors priced the stocks accordingly. But now silver is trading above $80 an ounce. In fact, silver crossed $90 recently, with gold surging above 5,000 simultaneously. And those same mines that were generating thin margins at $30 silver are now printing cash at multiples of what they were before. The all-in sustaining cost hasn't changed dramatically. What changed is the revenue line, and when revenue doubles or triples while costs stay relatively stable, the profit margin doesn't just double, it can increase by 5, 6, 7, or 8 times. That is the leverage story of silver miners. That is what the market has not yet fully priced in. Baker Steel Capital, one of the world's premier precious metals investment firms, stated explicitly in their January 2026 outlook that mining equities remain historically undervalued on both a relative and absolute basis, despite the extraordinary gains of 2025, and that the re-rating of the silver sector has only just begun. Now I want to walk you through exactly why the supply side of this equation cannot be fixed quickly, because this is the piece that most analysts gloss over, and it is absolutely critical to understanding the multi-year nature of what is unfolding. Right now, approximately 75% of all silver mined globally comes as a byproduct of mining other metals, copper, zinc, lead, and gold. That means that when silver prices go up, the incentive to produce more silver doesn't simply translate into new silver mines opening up, because most of the silver supply decision is being made by copper miners, zinc miners, and lead miners who are making decisions based entirely on those primary metals. You are a copper miner and copper prices are flat. You do not spin up a new massive copper mine just because silver, your byproduct, went up. The economics don't work that way. On top of that, the primary silver mines that do exist are producing from aging ore bodies with declining grades. Silver mine production has actually decreased by 7% since 2016. Global mine supply sits at roughly 820 million ounces per year. Meanwhile, annual demand has now surged past 1.2 billion ounces. That is a structural deficit of nearly 400 million ounces per year. If those demand figures continue to hold, and there is every reason to believe they will not just hold but grow. Even if the industry wanted to bring massive new silver supply online, it takes a minimum of 7 to 10 years from discovery to production for a new mine. The permitting alone in most jurisdictions now takes 3 to 5 years. The capital markets have not been funding silver exploration at anywhere near the pace needed to address this deficit. The future mine supply curve is not going up, it is actually declining, and demand is accelerating simultaneously. That is an extraordinary setup. Let's talk about demand, because the demand side of this story has permanently changed and the market does not fully understand it yet. Silver is no longer just a monetary metal, and it is no longer just jewelry and photography and silverware. Silver has become the indispensable metal of the 21st century industrial economy, and here is why. Silver has the highest electrical conductivity of any element on the periodic table, not copper, silver, the highest. That means that in a world that is rapidly electrifying everything, electric vehicles, solar panels, AI data centers, 5G infrastructure, advanced semiconductors, medical devices, satellites, defense systems, silver is absolutely irreplaceable, and there is no good substitute. The solar photovoltaic industry alone has seen its silver demand nearly quadruple since 2015, going from around 60 million ounces a year to over 232 million ounces in 2024. Each gigawatt of solar capacity installed requires approximately 700,000 ounces of silver. As governments around the world race to build out renewable energy infrastructure as the energy transition accelerates, that demand is going to keep climbing. A research paper examining total silver demand scenarios out to 2030 found that global annual silver demand could reach 48,000 to 54,000 tons per year by the end of the decade, while supply may only cover 62% of that need. That is a chronic, structural, decades-long shortage building. Now, add to that the fact that AI data centers and the GPU infrastructure powering the artificial intelligence revolution require silver for high-frequency interconnects and thermal management, where no substitute delivers the same performance, and you begin to understand that the new demand drivers for silver never existed in any previous bull market. This is different this time, and for once that phrase is actually justified by the data. And then there is the monetary demand story, which is the layer that takes this from a great commodity trade to a potential generational wealth event. We are living through the most extraordinary currency debasement in modern history. The United States has run budget deficits totaling trillions upon trillions of dollars. The Federal Reserve has expanded its balance sheet to levels that were considered science fiction just 15 years ago. Every major central bank in the world has followed the same playbook: print, spend, borrow, and hope that the inflation doesn't destroy the currency before the next election cycle. It never works long term. It has never worked in the entire history of human civilization, going back thousands of years. And what historically happens when currencies are debased? People seek refuge in real, tangible, scarce assets that governments cannot print: gold and silver. Always. This has been the pattern across Rome, across Weimar Germany, across every hyperinflationary episode in history, and the pattern is now playing out again on a global scale. The difference this time is that silver is not just a monetary hedge. It is simultaneously the most critical industrial metal for the technologies that are going to define the next 20 years of human civilization. Two demand streams converging on a supply structure that cannot respond. That is the setup. Now let's look at the gold to silver ratio, because this is the technical and fundamental indicator that screams loudest about where we are in this cycle. The gold to silver ratio simply measures how many ounces of silver it takes to buy 1 ounce of gold. Historically, when precious metals bull markets reach their peak, this ratio has collapsed to around 30 to 1, meaning silver has massively outperformed gold on the way up. In April of 2025, just 10 months ago, that ratio was sitting at a staggering 104 to 1, 104 ounces of silver to buy 1 ounce of gold. That was the most extreme overvaluation of gold relative to silver seen in decades, and it screamed that silver was coiled like a spring. Since then, silver has exploded and the ratio has collapsed to around 50 to 60 to 1 as of year-end 2025. But here is what you need to understand. That ratio has historically bottomed in the 30 to 1 range, and some analysts believe it could go even lower given today's unique supply-demand dynamics. Ogwog Funds, a specialist silver investment firm, projects the gold to silver ratio will reach 45 to 1 in 2026 and ultimately 30 to 1 over the coming years, which at a gold price of $6,000 would imply silver at $133 an ounce. If gold continues its ascent toward $8,000, which multiple serious analysts are now projecting, and the ratio compresses to 30 to 1, the math on silver's price becomes genuinely extraordinary. A GSR of 30 to 1 on $10,000 gold gives you $333 silver. That is not hyperbole. That is arithmetic. And history shows us that after post-dot-com recovery from 2003 to 2008, when the GSR peaked at 80 to 1, silver then went on a 340% rally. From 2008 to 2011, when the GSR spiked to 84 to 1, silver went on a 391% gain. We are coming off a ratio of 104 to 1, even more extreme than either of those historical peaks, and the unwinding has only just started. Now let's bring this home to where the real leverage lives, which is in the mining equities, and specifically in the junior silver miners, because this is where the 5x, 10x, 20x return potential exists for investors who are correctly positioned ahead of the institutional re-rating that is coming. Think about what happens to a silver mining company financially when silver goes from $30 to $100. If that company's all-in sustaining cost is $18 an ounce and silver is at $30, their profit margin per ounce is $12. At $100 silver with the same cost structure, their margin is $82 per ounce, nearly 7 times larger on the same production base. Multiply that across millions of ounces of annual production, and you get earnings that are unrecognizable compared to what the market priced into those stocks when silver was at $30. The stock market has not caught up to this new earnings reality. The mining stocks are still being valued in many cases using the cautious conservative analyst estimates that were built before silver's 147% surge in 2025. As earnings seasons report out the actual cash flows being generated at these new price levels, institutional money will flood in, valuations will re-rate violently, and the investors who were positioned ahead of that moment will see extraordinary returns. Rick Rule, one of the most respected and disciplined capital allocators in the history of the natural resource sector, has publicly stated that he has recycled capital from physical silver holdings into the miners ahead of exactly this re-rating. The man who has spent 5 decades identifying exactly this type of generational opportunity is telling you where the leverage is. It is in the equities, not just in the metal. The SALJ ETF, the Amplified Junior Silver Miners ETF, gained 195% in 2025, outpacing physical silver's 109% gain. The SALJ ETF, tracking larger silver miners, also dramatically outperformed the S&P 500, bonds, real estate, and most every other asset class on the planet. And despite those gains, both ETFs remain historically cheap relative to silver prices. Pan American Silver completed a $2.1 billion takeover of MEG Silver. Core Mining completed a $1.7 billion acquisition of Silvercrest Metals. The consolidation of the silver mining sector is accelerating as larger companies recognize that organic production growth takes too long, and acquiring junior miners with proven resources at current valuations is the fastest and cheapest way to grow. Merger and acquisition activity in a sector is one of the clearest signals of what the insiders believe about where prices are heading. Companies do not spend billions acquiring assets they think are going to fall in value. Let me put the macro picture together for you so you can see the full frame of what is happening. The United States added silver to its official list of critical minerals in November of 2025. That is a government designation that triggers prioritization, potential subsidies, and strategic stockpiling considerations. The implications are enormous. It means the U.S. government itself has formally acknowledged that silver is strategically critical to national security and the energy transition. JP Morgan now projects silver will average $81 an ounce for full year 2026. Gold Silver's lead analyst expects silver above $100 with potential for $175 or higher. AWA J Funds projects $133 silver in 2026. Peel Hunt raised their full year 2026 silver forecast to $75 an ounce, a 79% increase from their previous estimate, and raised their long-run silver price estimate from $30 to $50, effectively admitting the market has permanently repriced. Spot silver has already been trading above $78, above $90, with continued momentum, and silver remains measured against inflation-adjusted targets and against the explosion in global M2 money supply, dramatically undervalued. When measured against the total amount of currency that has been created since the early 2000s, silver has not even begun to catch up. Inflation-adjusted price targets, depending on methodology, range from $150 to $250 an ounce. That means even after a 137% surge in 2025, silver may still be in the early innings of its repricing against the currency debasement backdrop. Here is what I want you to walk away understanding today. We are at the intersection of at least four simultaneous powerful forces that are all pointing in the same direction. First, a structural physical supply deficit that has now run for 6 consecutive years and cannot be fixed quickly because of the decade-long lead time to develop new mines. Second, an accelerating industrial demand revolution driven by solar energy, electric vehicles, AI infrastructure, 5G, and semiconductors, creating price inelastic demand streams that grow regardless of silver's price because there is simply no substitute. Third, a monetary demand surge driven by currency debasement, record government debt, and the return of gold and silver as the ultimate stores of value in a world where every major currency is being inflated away simultaneously. And fourth, a valuation gap in mining equities that still has not been closed, where companies generating extraordinary cash flows at 80 Tucker to plus silver are still being valued by the market on the old paradigm of $28 to $30 silver. When that valuation gap closes, and it will close, it always does, earnings reality always catches up to equity prices eventually. The re-rating of silver mining stocks could be the most violent and rapid repricing of an entire sector that most investors alive today have ever seen. The window for positioning in the silver mining sector at these levels will not stay open indefinitely. As each quarterly earnings report comes in showing the extraordinary free cash flow being generated by these companies, as each institutional analyst updates their models, as each hedge fund and family office and sovereign wealth fund realizes that silver miners offer equity-like returns with gold-like protection and industrial demand certainty that no other sector can offer, the capital will rotate in, and it will rotate in fast. Silver went up 147% in 2025, and most mainstream investors still don't own a single ounce of silver or a single share of a silver miner. That is the opportunity. That is the gap between where the crowd is and where the data points. Cycles in precious metals are long, violent, and they reward those who understand the fundamentals and position before the consensus catches on. The fundamentals here are not ambiguous. The deficits are real, documented, and growing. The demand is structural and accelerating. The monetary backdrop is the most favorable for precious metals in modern history. The miners are cheap. The window is open. The question is not whether this move is coming. The question is whether you intend to be positioned when it arrives.